Welcome back to the Crow Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're doing a real deep dive. We got this dense mix of sources, financial headlines, news articles, market analyses, mostly CNBC, Bloomberg, dated around October 14th, 15th, 2025. And our mission really is to unpack these three big intersecting areas of global volatility. We're talking geopolitics, the frantic pace of the AI market, and some really surprising shifts in consumer sentiment.
Yeah, and it's a moment where, frankly, market direction feels less about the traditional fundamentals, doesn't it? It's much more about rhetoric, policy shocks. It's leading to these extreme swings. I mean, just look at Tuesday's session. The S&P 500, it finished down 0.2%. Okay, fine. But that number hides the fact it swung wildly, like almost 2 full percentage points during the day.
Wow.
And the NASDAQ dropped 0.8%. So volatility isn't just, a side note. It is the story for investors like you right now.
Okay, let's unpack that market anxiety then. Starting point has to be the U.S.-China relationship. It's just dominating everything. And the latest salvo, well, it feels more like policy by impulse, maybe. President Trump's threatening new retribution. He's still hitting Beijing over halting U.S. soybean purchases way back in May. He's calling it an economically hostile act.
And the specific threat is getting almost strange, niche. CNBC reported Trump's now considering and publicly terminating business with China having to do with cooking oil.
Cooking oil.
Yes, and that's on top of the broader threat from last week. Remember, the additional 100% tariff on Chinese goods, potentially starting November 1st.
Hold on. Cutting off trade over cooking oil? I mean, that sounds like pure political rhetoric, right?
Mm-hmm.
It's just designed to spook the market, not a real industrial strategy. Is the impact even that immediate?
Well, the rhetoric's impact is immediate market jitters, yes. But we need to look past the cooking oil thing to China's actual strategic response that's far more serious. So Beijing responded. They sanctioned 5 U.S. units of a South Korean shipbuilder, Hanwha Ocean. Analysts mostly see that as, a mild warning gesture, not much immediate business impact.
Okay, it's symbolic.
But then they did something much bigger. They weaponized their control over critical supply chains, rare earths.
Right, the expansion of the rare earth export curbs. That's what Bloomberg's been reporting on. Why is that move so much more significant than, say, another tariff hike?
Because China holds the keys to the kingdom here. They control the bottleneck. We're talking roughly 60% of world production and over 90% of the permanent magnets made from these materials. And this latest move expands the restricted list, adds 5 more specific rare earths, holmium, europium, ytterbium, thulium, and erbium.
Okay, instead of just listing those complex names, what are they actually used for? These like super niche defense things, or are they more foundational?
Yeah.
Oh, they're absolutely foundational, these specific elements. Crucial. High temperature permanent magnets, advanced optical fibers, used in everything from EV motors, core to the whole green transition,
Right.
to high-tech semiconductor manufacturing, specialized medical gear. So this isn't just about 5 obscure elements. This move structurally messes with the EV and high-tech roadmaps for the next decade. It makes every Western manufacturer basically dependent on China's political mood.
That definitely explains the reaction from industry groups. I saw the German Automotive Association, the VDA, they're sounding the alarm, saying these curbs will have far-reaching consequences for batteries, semiconductors.
Exactly. And U.S. Treasury Secretary Scott Bessent, he was quoted saying, China's actions are like pointing a bazooka at the industrial base of the free world.
A bazooka. Strong words.
Sounds hyperbolic, maybe, but the threat's real because alternatives aren't immediately available for many countries. Which brings up an interesting point about market divergence. Despite all this U.S. volatility we're talking about, Asia-Pacific markets actually traded higher on Wednesday.
Yeah.
South Korea's Kospi jumped 2.68%. They sort of broke ranks with Wall Street.
That is remarkable. So investors are seeing the risk, but maybe not everywhere. How do they react globally beyond equities?
Classic safe haven flight. Gold hit a new record, over $4,200 an ounce. Silver surged, too, according to Bloomberg data. Now, obviously, U.S.-China friction helps precious metals, but there's probably a stronger fundamental driver here, too. Fed Chair Powell hinted the Fed might be nearing the end of reducing its bond holding.
The quantitative tightening.
You're right, the taper. And the implication is rate cuts might be coming sooner than folks thought. Lower yields always help non-yielding assets like gold. Makes them more attractive.
Okay, let's pivot. Shifting gears to assets that seem to be, defying gravity, regardless of these trade war headlines. That takes us straight into tech, right? Specifically AI. There are 2 big stories there. This major policy shift is OpenAI, and then the constant bubble fears versus investment reality.
Yeah, the OpenAI policy change is huge, really reflects the whole internal debate about the social responsibility of these AI models.
Hmm.
CEO Sam Altman announced ChatGPT will soon allow erotica content, but only for verified adults. They're planning to roll out age gating more fully in December.
And his reasoning, according to CNBC, it's about, quote, treating adult users like adults. He apparently feels the old bans were pretty restrictive and made the chatbot less useful for some. He also mentioned new safety tools to mitigate potential mental health issues, which allows him to relax those bans.
But it's critical to remember the context here. This change comes amidst really intense external pressure. There's that ongoing FTC inquiry and also a very public lawsuit about the chatbot's alleged role in a teenager's suicide. So while they're relaxing content rules for adults, they're simultaneously facing more scrutiny than ever on basic safety. It's a tricky balance.
Definitely. Now let's look at the investment side of AI. The boom just keeps rolling, but those bubble warnings, they're getting louder. Bank of America's latest Global Fund Manager survey actually cited an AI equity bubble as the top global tail risk for the first time.
That's right. And cash levels among these managers are apparently nearing the historical sell signal threshold, suggests they're pretty much all in on risk assets. Strategists admit valuations are stretched. You hear the phrase pricing to perfection a lot.
Okay, pricing to perfection. For those of us not on a trading desk, what does that actually mean in practice? Like, what's the risk?
It means the market assumes everything will go perfectly right. Flawless execution by the companies, nonstop demand growth, ever-expanding margins, no room for error. So if one of these high-flying AI stocks just hiccups, misses an earnings estimate even slightly, the stock could just collapse. Because there's zero buffer, zero margin for error baked into that sky-high price. It's fragile.
Very fragile. Yet despite that fragility, the money keeps pouring in. We saw Oracle making that huge bet on AMD chips, 50,000 of them, starting second half of 2026, diversifying from NVIDIA. And then Walmart struck that deal with OpenAI for faster purchases via ChatGPT. Walmart shares popped 5% on that news.
And you know, the semiconductor equipment maker ASML, they kind of perfectly bridged this AI boom excitement with the geopolitical risks we talked about earlier. Their latest earnings give a great microview.
Right, ASML. They reported strong Q3 orders, $5.4 billion, clearly benefiting from all the AI investment. But what was the geopolitical warning shot there?
The CEO, Christophe Fouquet, was very clear. He warned ASML expects a significant sales decline in China next year compared to 2024 and 2025.
And that's directly because of?
Directly tied to the tighter U.S. export restrictions, limits what advanced tech they can sell into China. But to try and calm the market nerves, the company did affirm they don't expect total net sales in 2026 to fall below 2025 levels, which suggests, AI demand elsewhere in the world is strong enough for now to make up for the China gap.
Okay, let's zoom out again. From the corporate drama, the political theater. How is all this translating to the person on the street? We've got some fresh data showing, frankly, surprising levels of anxiety among consumers.
Yeah, that latest Deloitte survey is pretty stark, really shocking, actually. Found 57% of U.S. consumers expect the economy to weaken in the year ahead. And Deloitte pointed out that's the most negative outlook they've recorded since they started tracking this way back in 1997.
Wow, since 1997, that's significant pessimism. A huge headwind.
And it translates directly into spending plans, as you'd expect. Consumers, on average, plan to spend 10% less this holiday season.
But digging into that data, the generational split is what really jumped out at me.
Oh, absolutely. The demographic breakdown is incredibly revealing. It really suggests that whole resilient consumer narrative might be breaking down, especially for younger people. Gen Z, that's ages 18 to 28, they plan to spend a dramatic 34% less this holiday season.
34% less.
Yeah. That's not just, trimming the budget a bit. That kind of massive cut points to intense pressure from inflation, housing, groceries, the basics, combined with real career uncertainty. When Gen Z feels they have to slash holiday spending by a third, it tells you their core budget is already stretched to the breaking point.
Meanwhile, across the Pacific, China's battling the opposite problem, right? Deflation. Underscoring that sluggish domestic demand we keep hearing about.
Correct. China's consumer price index fell again, 0.3% year-on-year in September, still in deflationary territory. Now, core CPI, stripping out food and energy, that did rise 1.0%. But you still had producer prices deflating, plus all the trade worries. The overall deflationary pressure is still there. Analysts are pretty cautious about calling an end to it until consumption really picks up.
So U.S. consumers are deeply pessimistic. China's dealing with deflation. But then you have this contrast in Europe, unexpected green shoots. European markets actually bounced back pretty strongly. France's CAC 40 jumped 2.5% of his biggest daily gain since April.
Yeah, and a lot of that recovery seemed driven by luxury brands.
Right.
LVMH, for example, surged almost 13%. They reported a surprise return to sales growth, just 1% organic growth in Q3, but it snapped 2 quarters of decline.
Interesting.
Oh.
So that suggests
It suggests maybe, just maybe, a tentative return of demand from wealthy Chinese consumers. That segment has always been a huge engine for global luxury. So even if the average Chinese consumer is struggling, the high net worth folks might be starting to spend again. Signs of life there.
Okay, one last piece of the puzzle. The UK's fiscal situation. Sounds like they're walking a tightrope.
Very much so. The Chancellor, Rachel Reeves, hinted pretty strongly that tax rises and spending cuts are on the table for the November budget. Why? To meet their ironclad fiscal rules. And that might mean sacrificing a previous pledge not to raise taxes on working people, just to balance the books amid all this global uncertainty. Tough choices ahead there.
So pulling it all together, we've covered these really divergent storylines today, haven't we?
Profoundly divergent, yeah. On one side, you've got these escalating geopolitical tensions, threatening industrial bases with, bazookas, like rare earth curbs. Then on the complete other side, AI innovation just keeps driving these massive orders for equipment globally.
And caught in the middle is the consumer. The U.S. consumer is historically pessimistic, according to that Deloitte survey.
Right. But then we see these flickers of life in high-end global consumption, thanks to brands like LVMH maybe seeing Chinese demand return. It's a real mixed bag.
So the key theme for you, the listener, to take away seems to be this ongoing battle, uncertainty versus this sort of entrenched investment momentum. Will the cooking oil embargo talk and the very real rare earth squeeze finally break the AI-fueled market rally?
Okay.
Or can tech just keep defying political gravity?
And maybe frame the next few weeks with this in mind. China's leaders are gearing up for the 4th plenum next week. Now, for anyone not following CCP politics day to day...
Which is most of us.
Exactly. The plenum is basically where the party sets the big strategic goals, the ideological tone for the next 5-year plan. And this upcoming one, all signs point to a heavy focus on self-sufficiency. In AI, advanced chips, critical materials, the very things causing friction now.
So with Beijing clearly doubling down on strategic self-reliance, maybe the provocative closing thought is this. Are the U.S. and Europe moving quickly enough to secure their own critical supply chains, everything from rare earths to chips? Or are they perhaps relying a bit too much on hoping for a de-escalation that might just not be coming? We try to explore all these complex details from the major financial news sources today just to give you a clearer picture of these shifting global currents. We'll see you all tomorrow morning with new headlines from major financial magazines.